In this video we are going to talk about the magic of compounding dividends. So before starting, please like this video and subscribe to this channel for our future updates. The risk associated with any financial investment, including the capital at risk, must be considered. Therefore, like with all investments, the value and income provided by the investment will change over time, and the amount of the initial investment cannot be predicted or guaranteed in advance, as is the case with most other types of investments. One of the most significant fundamental truths is that the vast majority of investors are aware of what it is they are investing in. Buy low, sell high. That is the motto of the stock market. That is the stock market's mantra, if you will. If you will, you may say that this is the stock market's mantra. Keep in mind that you should avoid putting all of your eggs in one basket at the same time. Keep your market predictions to a bare minimum and don't expose yourself to more danger than you are comfortable with. People, on the whole, are less familiar with the magic of compounding and how it can lead your returns to increase considerably as a result of this. For the uninitiated, compounding refers to the fact that by continuously putting smaller sums of money into your investments over time and allowing them to grow, your return on investment may easily be better over the long run than if you simply put a large amount of money into your investments and hoped for the best. A little known fact about investing is that dividend reinvestment allows you to profit from the power of compounding while also reducing your risk. Dividend distribution refers to the regular payment of dividends to shareholders who own stock in a firm on an ongoing basis, often once or twice a year. In exchange for their investment, bond holders receive a coupon in the mail. As previously indicated, some investors choose to utilize the money they get as ordinary income, while others choose to reinvest it by purchasing additional shares of the same stock or bond that they previously purchased, as explained above. In the next sections, you will learn how compounding can be used to your advantage. If you had invested £1,000 on August 31, 1998, and received dividends as income, your investment would have been worth £1,682.30 on August 31, 2018, assuming that the fund's value did not increase in value over time. If the fund's value did not increase over time, if you had invested £1,000 on August 31, 1998, and received dividends as income, your investment would have been worth £1,682.30 on August 31, 2018, which is unlikely. Individuals who choose to reinvest their gains would now have a £1,000 investment worth £3,268.10, a more than threefold increase, nearly double its original value during the same time period. The exact reason for this discrepancy is still a mystery. The fact that you are receiving a return, not just on the lump sum you initially invested, but also on the dividends you receive and reinvest, means that your money is working even harder for you as a result of your investment. You may measure your return on investment by checking the dividend yield of a stock, bond, or market. If you are interested in tracking your return on investment, this is a great method to use. If you invest £100 in shares in the FTSE All-Share Index at the current dividend yield of 3.78%, this indicates that you can expect to receive a dividend in the form of a cash payment equal to 3.78% of your initial investment. But the yield is susceptible to swinging in any direction at any time of day or night, regardless of the market conditions. However, while dividend yield can be used to establish whether or not a company is in good health, corporate boards of directors have the ability to lower dividend payouts as and when they deem appropriate. In the event that a bond issuer's obligation to pay bond coupons is breached, the obligation to pay bond coupons remains in effect. In order to better grasp what I'm talking about, consider the following illustration. Every £100 you put into a stock will result in a dividend payment of £3, which will be received in return in Only a year's time, the stock's value has improved by 5% in terms of dollar value. After deducting the dividend, your investment is now worth $108 as a result of the effects of inflation. In the event that there is no further increase, your investment is now worth $108. In the following year, your £108 grows by 5%, reaching £113.40. With another £3 dividend, it grows to £116.40, bringing the total value of your investment to £116.40. In the following year, your £108 grows by 5%, reaching £113.40. If you hadn't chosen to reinvest your winnings, the value of your initial £100 investment would have been only £110.25 if you hadn't made the decision to do so when you initially began off. Initial appearances may suggest that there is no difference, but over a period of 5 to 10 years, or even over a longer period of time, those returns begin to pile up. You should take advantage of compounding interest by holding on to your investments for as long as possible in order to reap the benefits of it. It is crucial to remember that no matter how long you are involved in the company, there are no assurances that you will be able to recover the money that you invested. It is inevitable that the market will fluctuate, and if the wind is blowing in the opposite direction of what you want to achieve, compounding will not be nearly as successful as it would be otherwise. The fact that dividends are being paid out at this point will simply serve to increase the amount of money invested in a declining stock, which is the polar opposite of what you are aiming to do with your investment in the first place. It is not necessary to change your present technique in order to take advantage of current market conditions, but it is recommended that you do so in order to maximize profits. Contrary to popular belief, it produces the opposite effect. It is always preferable to invest small amounts over time in any market, regardless of how good or bad the market's performance has been overall. For example, investing small amounts monthly through your ISA is always preferable to saving and investing a large lump sum, regardless of how well the market has performed in general. Thus, it contributes to smoothing out market peaks and troughs while also making certain that a significant decline in the fortunes of your chosen company does not preclude you from investing in other companies in the future, should the case warrant it. In order to maximize your returns from a diversified and professionally managed fund, whether it is actively managed, in which a fund manager selects securities, or a passive fund that tracks an index, such as the FTSE 100, it is critical to select the appropriate share class based on your investment objectives and risk tolerance. The term accumulating refers to the fact that the fund collects all dividend payments and reinvests them in the fund on your behalf, as opposed to a mutual fund, which would reinvest all dividend payments in the fund on your behalf. The majority of mutual funds deposit dividends into their shareholders' bank accounts once a year or twice a year, but in some cases, certain funds deposit payouts as frequently as once a month. The letter INC is an acronym for the phrase increased revenue. Individual stocks and bonds can be purchased through a broker or trading platform, and you can set up a plan to reinvest dividends or get income from your investments, for example, if you want to diversify your portfolio. It is also perfectly okay to remove your income from your mutual fund account if the money is required for another purpose. Everything is based on your time horizon, the level of danger you are ready to accept, and the quantity of money you require to get started. Depending on your position and goals, a financial counselor may be able to assist you in determining the best course of action. What do you think about our video? Please let us know in the comments area below. If you enjoyed this video and would want to hear from me again, please subscribe and turn on the notification before leaving. Thank you for watching us.